Well, hello there. I'm Gemini.
Welcome to The Explainer. Today, we're going to talk about something every Canadian entrepreneur dreams of, how to stop just surviving and start building some serious, long-term wealth. We're going to break down the key strategies that can actually get you there.
So let's just get right to it with a really important question. Think about it for a second. Is your business just a machine for paying this month's bills? Or is it something more? Is it engineered to be a powerful engine for your financial future? Because honestly, how you answer that changes everything.
All right, so here's how we're going to break it all down. First, what does serious wealth even mean in this context? Then, we'll jump into why being a corporation is such a game changer. Look at some smart ways to handle your income, talk about the huge capital gains payoff, and then wrap it all up with a blueprint you can actually use.
Okay, first things first. We need to shift our thinking a little bit. This isn't just about how much profit you make this year. It's about building real, after-tax wealth. You know, the kind that actually grows and compounds over time. And that whole journey starts with how you decide to structure your business.
I mean, this really says it all, doesn't it? It's a simple idea, but it is huge. Let me say it again. It's not about what you earn, it's about what you get to keep. Tax efficiency isn't just some boring accounting term. It's the absolute heart of building wealth. And your number one tool for keeping more of your hard-earned cash, you guessed it, the right corporate structure.
Okay, so that brings us to the foundation of all of this. Let's talk about the single most important vehicle for creating wealth if you're a business owner in Canada, the corporation. And it is so much more than just a way to protect yourself from liability. It is, and I'm not exaggerating, a financial powerhouse.
So, we're zeroing in on what's called a Canadian-controlled private corporation, or CCPC for short. And man, the advantages you get with a CCPC, they're things you just can't touch as a sole proprietor. We're talking more buying power, real flexibility with your fiscal year, the ability to defer taxes, the list goes on.
Okay, get ready for this because this is where it gets really interesting. Look at this difference. As a sole proprietor, your profits could get hit with a personal tax rate of around 50%. Half your money just gone. But look at the other side. Inside a corporation, that same money can be taxed as low as 9 to 15%. That is just, wow. The difference is absolutely massive.
So what does that massive tax difference actually mean for you? It's simple. More capital. More cash left in your company's bank account after the taxman gets his share. And that's not just numbers on a page, right? That's your power to go out and buy that new piece of equipment, to hire that key person to actually fuel your growth. Now, here's a superpower that a lot of people don't even think about. If you're a sole proprietor, you're stuck with the calendar year, December 31st. That's it. End of story. But a corporation, you get to pick your own year end. And why does that matter? It gives you this incredible control to time your bonuses and dividends, maybe even push some personal income into the next year to save on tax. It's a huge advantage.
All right, so we've got our foundation, the corporation. Now let's get into the really cool stuff. The advanced plays for managing your income and, legally keeping more of it away from the taxman.
Okay, so for years, one of the classic strategies has been income splitting. The idea is pretty straightforward, right? You pay your spouse, or maybe your kids who are older, a reasonable salary for the real work they do in the business. And what that does is it pulls money out of your high tax bracket and puts it into their lower one. The whole family ends up paying less tax. Simple.
Simple. At least, it used to be. Then 2018 rolled around and, well, the government decided to make things a lot more complicated. They brought in a whole new set of rules that really cracked down on this, especially when it comes to paying out dividends to family. The game totally changed overnight. And that's where we meet our new friend, TOSI, which stands for Tax on Split Income. And you got to be careful with TOSI because it's basically a trap. If you get it wrong, any dividends you pay to certain family members could get slammed with tax at the highest possible rate. It completely wipes out the benefit you were trying to get in the first place. So how do you avoid this trap? Well, the game has shifted. Now, the burden of proof is on you. You have to be able to show the CRA that what you're paying your family member is actually reasonable. And they're going to look at things like, did they actually put their own money into the business? Are they taking on real financial risk? What have you paid them in the past for their work?
And look, don't just take my word for it. The author of the material we're looking at, Evelyn Jacks, puts it perfectly. This is very complex and requires the help of a tax specialist. Let me say that again. This is not something you want to try and figure out on your own at the kitchen table. You absolutely need a pro in your corner for this.
Okay, now we get to the part we've all been waiting for, the end game. the grand prize. This is, without a doubt, the single most powerful wealth-building tool out there for a Canadian business owner. It's the reward for all those years of risk and sleepless nights.
I am, of course, talking about the Lifetime Capital Gains Exemption, the LCGE. Think of it like a golden ticket. It's a special tax rule that lets you sell the shares of your business one day and get a massive chunk of that money, 100% tax-free. No, you did not hear that wrong. Tax-free. So, how much are we talking about here? For a qualifying small business corporation, you can get over $900,000 of capital gains completely tax-free. Let that sink in. Nearly $1 million in your pocket with a tax bill of $0.
And it gets even better. If you're in farming or fishing, that number jumps to a cool $1 million. This is the kind of stuff that changes a family's future, and it's all possible because of smart, long-term planning.
Okay, so we've covered a lot. We've got the foundation, we've looked at the strategies, and we've seen the big prize at the end of the road. So the big question now is, how do you actually put this all together? What's the plan?
Well, here it is, your blueprint. It's really 4 key steps. First, you gotta figure out if incorporating is the right move for you. Second, you have to be super careful about planning your income, especially with those tricky TOSI rules. Third, and this is huge, always have the end game in mind. Structure your business from the start so you can take advantage of that capital gains exemption someday. And last, but honestly it's the most important one, don't go it alone. Partner with a qualified tax advisor to guide you. So, that brings us right back to the question we started with. You have to stop thinking about your business structure and tax planning as just another expense on the books. It's not. It is hands down the single biggest investment you can make in your own future. So you've got to ask yourself, are you building a business just to get by today, or are you building a legacy that will last for generations? The choice is yours.